Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Joining me today is Randy Hargett. Randy, how are you doing?
I'm doing good, Casey. How are you doing?
Great. Thanks for doing this with me today. I think you've been on maybe 4 or 5 podcasts now over the last couple of years we've been doing this, and I appreciate your enthusiasm to do it. Randy, tell me, I guess, a little bit about your company and what it is that you guys do.
Well, we have been specialized in long-term care planning for the past 20 years. And that's pretty much all we've done. And we also do the same type of market evaluation for life insurance. But we are specialized in long-term care, and probably for the past 8 or 10 years, our focus in our practice has been mainly in the Southeast, the states of Mississippi, Alabama, Georgia, Tennessee, South Carolina.
Okay. And I actually met you through a gentleman who found you through the Dave Ramsey Network. So you're a trusted Ramsey advisor as well.
I am a Ramsey trusted advisor for the whole states of Alabama, Mississippi, Georgia, Southern Tennessee, and South Carolina. And so,
okay. Well, long-term care insurance, that's something we cover in our financial planning process. And for people who already have policies, we lean on you to review them for us. And for people who don't, who are interested in a policy, we lean on you for education on that front. So I guess, why don't we start with, long-term care insurance. The default, I think, thought is, it's too expensive. And so you have to, there's some math there, but what would you say, people should start looking? Is there an asset level that people should start, an income level people should start looking at long-term care, or what are your thoughts on who needs it?
Well, the people who need it are people really that can be in one of two categories. When we were years ago, we would shop for clients, and we would look for anybody that had an asset base of more than $100,000, something that's worth protecting. And the other is people that have an income that's being derived from an investment. Because if that person has to spend $100,000 a year out of their investments to pay for long-term care, then they're also affecting their income stream.
Yeah.
So I would say that 20 years ago, most people that had more than, say, $1.5 million of assets were told by their financial advisor, you can self-insure. And pretty much in the past 20 years, the main litigation that's gone on in the long-term care industry were when a mother got Alzheimer's and stayed in a nursing home for 12 years and wiped out $2.1 million. And the kids say, why didn't you have this insurance? And they say, well, my advisor told me not to, that I could self-insure. And she could have afforded to to protect at least part of her asset base. And so it's a wide range. Some people do it simply because they don't want to be a burden on their family, and they want their family to see some kind of help when they need to be cared for. In my case, the reason I'm in this is because I watched my dad spend his mother's money and sell all of her real estate in order to pay for her care. And he didn't want to do that. Yeah. And if she had had something to help, it would have been good. Now, the other part of your question was the price. If you try to buy a long-term care policy that's going to pay for everything, then it is probably most unaffordable for everybody. Our philosophy is that you only need a long-term care policy that is substantial enough, and that is quite variable from person to person, substantial enough to make a difference for your family. Because what we have learned over the years is that people buy long-term care insurance for the same reason that they buy life insurance. It's because they love their families.
Right.
And they don't want to be a burden on them. And so when you buy a policy that can help you pay for your long-term care, not necessarily pay for all of it,
right,
I can say that the strategy and using that strategy in 20 years of doing this, whether somebody purchased the insurance or not, in every single case, they would say this is not as expensive as I thought it was going to be. And that has all to do with how the planning is done.
So what are some different types of long-term care? I know that there's various, my favorite is for families, higher net worth families, is the hybrid one where basically you write one check, it's paid up. And if you don't use it, then majority of that check plus more goes back to your beneficiaries. Be the last to die for a married couple. But that, to me, that's a real easy sell.
Yeah.
Versus
Well, three kinds of long-term care. That's one of them is the hybrid. Probably 70% of our business is traditional long-term care insurance, which is like your homeowners.
Right.
You have a fund of money that can rebuild your house. In this policy, you have a fund of money that you can pay for your care. And if you don't need to be cared for, if you don't burn your house down, you've just been covered with insurance. You don't have any cash value, residual benefit, or death benefit.
Yeah.
And that's what some people want.
So inside traditional though, there's all kinds of bells and whistles that can be fairly inexpensive, really, or it can be very expensive, right? Depending on what you're.
Right, and that's all in how we plan. What we do is we try to help people get into the paradigm of we're not trying to purchase some insurance that's going to solve every problem, or like some of these auto commercials are saying that we're going to replace your car with the new model just like itself. We're not going to do everything, but we're going to design a plan that's going to be substantially beneficial to whoever's handling your affairs. Because when it comes to long-term care insurance, you're not doing this for yourself. You're doing this for the person that's going to be handling your affairs, because you may not even know that the policy is being used while they care for you. And so that's traditional. Like you said, hybrid is the second level. And, I even like to call, in fact, it was one of your clients that gave me this terminology that after he looked at that hybrid solution you talked about, he said, this is kind of like a self-insuring model, because it allows you to self-insure for a short event. And one of the things that I do is I ask everybody, especially people that have more than 7 figures in an asset base, could you self-insure a year or two in a nursing home at $80,000 or $90,000 a year, and it not dramatically affect your asset base?
Right.
And the answer to that question is yes, because they've been thinking about self-insuring anyway. Now, the next question is, well, would you want to self-insure a 12-year Alzheimer's event?
No.
And the answer to that question is no. And so the solution Casey just mentioned, for anybody that hasn't heard about it, is actually a solution that the company had a patent on for 25 years up until about 8 years ago, that actually allows you to self-insure for a short event. And if that long event occurs, you are protected for your lifetime with long-term care income if you need to be cared for a long time. And if you don't need to be cared for, the self-insuring part of it actually stays in your asset base, on the asset side of your ledger in the form of a death benefit. And so those are the two main types of care. The other types of policies that we do help people a lot with is called short-term care insurance. And it can be either 1 or 2 years worth of benefit for home care or any kind of nursing home or assisted living. The prices are a lot lower because you're not purchasing as much coverage. The underwriting is a lot more liberal, so people that have health issues can qualify for it. And it actually would just give your family a hedge, give them some help. If you need to be cared for, it's going to give them some help to get that care going.
Is that a new concept?
It is not a new concept. The concept's been there all along, because the policies initially were designed probably 20 years ago for recovery, for helping people have some benefits to recover from a surgery or whatnot. And they have just added on to those policies to be able to do home care or facility care for 1 or 2 year periods. And so,
do you find that these newer policies are covering more for in-home care and even compensating family members for care?
Some policies do. That's the other difference between some of the traditional and most all traditional are what we call reimbursement. They'll reimburse you for care through a home care agency.
Yeah.
Some of the hybrid plans do what we call a cash indemnity, where they'll just pay you the cash money every month of whatever your benefit amount is, and you can pay whoever you want to pay. Those policies are more expensive because they're doling out more money. Most reimbursement plans are a lot less costly than the cash indemnity plans. And so, again, that goes back to philosophies. I mean, if I were to tell you, okay, Casey, I can get you $4,000 a month in cash, and you can pay one daughter a week or however many children you have
Right.
in cash to come over and care for you. Man, that sounds good. I really like to be in control of it. Well, what most people don't realize is that your family is going to do for you whatever they're going to do for you, whether you have insurance or not.
Yeah.
If they love you,
Right.
they will.
Right.
And what happens is if you try to design a long-term care plan that's going to pay a family member to care for you, then what you have done is you have confirmed that every hour of your care is going to be laid on the shoulders of that family member.
Right.
And so we try to help people see that paradigm as well, because one of the greatest devastations in long-term care is what it does to the caregiver.
Yep, that's right.
And
Especially
so
Alzheimer's and dementia type of stuff.
that's exactly right. And so laying all of that on the table helps people to see, I need to weigh that. I like the cash benefit, but I may not be wanting to pay my daughter. She's going to already have me living with her.
Right.
And so she's going to be taking care of me at night, and then she goes to work. It may be better for her that somebody else comes and does part of that.
Are you seeing any trends in long-term care that's starting to change? Because we have a demographic that's starting to use long-term care more. A lot of companies over the last 10 years have gone out of business. I think from my standpoint, the ones that are remaining seem to be more healthy. But do you see new trends on the horizon when it comes to long-term care?
We actually see some more companies coming back into the market now. And I think that's going to happen over time. And people try to make a negative out of that, but in reality, it's exactly what happens in the insurance industry. If you go back 50 years when disability insurance was introduced, there were 50 companies, all of them offering this disability policy. And over time, it filters down to the ones who are committed to it for the long haul. There's 10 or 12 today in disability. And so the same natural elimination has happened in long-term care, and the ones that are doing it today are committed to it. And so that's a trend. The other trend that's happened is that most companies are now adding to their policies a feature called care coordination.
Okay.
And because most of the time, like with my mother who just went on claim last year with her Parkinson's, we were able to help her find a home care agency and work with them and make sure that everything was lined up at the right times and the caregivers were on schedule. Well, in our society today, a lot of people have retired and moved to Florida or Arizona or wherever, and they're not around a family social network that can handle organizing their care. And so companies are now including independent care coordinators to help people do that when they don't have that social network to help them. And so that is something that's really come on in the past 3 to 5 years.
So that just comes with, because you pick a certain company, you get that automatically, or is that a policy add-on?
That is built into most all of the policies now.
Oh, wow.
You don't pay for it out of your benefits. It's paid for by the insurance company.
Interesting. So is that coordinating doctors, or
no? That would be coordinating caregivers.
Just okay. Interesting. Because you think that would be done by the caregiving company.
That's right. But if you're retired and you're living in Florida and you don't have anybody to help you, and all of a sudden you have a stroke,
yeah,
you need somebody to start finding the right home care agency
Got it.
that fits you, that has the services that you need.
Okay.
And once they start giving the services, helping to make sure that you're getting the
Yeah.
right kind of services.
Hopefully there's not a conflict of interest there, but yeah, I can see the need for that now. That's interesting. What are some things that you suggest, like when people start going down that journey of comparing long-term care policies? Let's say you're a family with net worth of $3 million, reasonable income in retirement. Where do you start? How do you start doing the math on how much you need?
Well, and with that particular person that you just described, my first question to them is, have you thought about self-insuring?
Yeah.
Because 100% of them have. And I think in the last 7 or 8 years, there's been just a dramatic increase in the amount of people in the 3 to 5 million range who have come into play to put a long-term care solution in place that thought they were going to self-insure. And
yeah, well, ultimately it protects the assets, because if your portfolio in retirement is growing around 5-6% per year, well, so is long-term care, right? In some cases, long-term care costs will outpace inflation. So you run into a scenario where it's almost like saving for college. It's just so expensive and it keeps going up so much each year. There's no way to catch it. You have to save more now to get there. And so
that's why we call it building a hedge of protection. We're not necessarily building a wall. We're building a hedge against this risk.
Yeah.
And when you use a hybrid plan, you have that hedge for long-term care, and you also have a guaranteed death benefit. Even though you don't need the death benefit, with the person that you just described may not need a death benefit, and we don't do it for the death benefit.
Yeah.
We use it because that long-term care solution is built around the chassis of a life insurance policy.
Correct.
That gives a guarantee both ways.
The way I see it is, let's say nursing homes want to cost you $8,000 a month. So in today's dollars, so $8,000 a month. Let's say you're getting $3,000 in Social Security, right? So they have $5,000 remaining. The portfolio can send you $3,000, right? So now you're down to $2,000. So now you have to take into account that the cost is going up so much each year. So maybe you go back to $4,000. You just need a policy for $4,000. You've seen a million emails from me say, hey, they need a hybrid policy with $4,000 monthly benefit. But when we do the math on our calculators, that just kind of seems to be the sweet spot. And you are correct in how you opened up talking about all this, is that, if you go to an agent, and I've had them in here in my office before I found you. If you found an agent say, well, this one will cost $9,000, so we need to insure you for $9,000 for long-term care, and you really don't. I mean, in how I just described it, you're still protecting your assets. You're not digging into principal at that point because of long-term care. And also too, you have to remember, we're talking about nursing homes. Prior to nursing home, the nursing home stay isn't very long, but it would be like assisted living. So these policies cover assisted living, but the cost there is correct. Only $4,500 a month. So most people could cover that on their own anyway. But the policies, if you have a $4,000 monthly policy to cover assisted living, you're really not coming out of pocket. You're almost living for free at that point, and you're probably continuing to build wealth. So it's a piece of it's a puzzle, and you kind of have to. Everyone's puzzle is shaped a little bit differently in how you get there.
Right, and with long-term care insurance, the most expensive part of long-term care insurance is if we add an inflation factor to that long-term care benefit.
Yes.
Because as you said, the costs are going to grow over time.
Correct.
If we go back to your person that you just described with a $3 million net worth, I will tell you that in most cases, I will not recommend that person to do an inflation factor.
Right.
And the reason is, if that person is 58 years old, by the time they're 72, they're going to be required to take distributions.
Right, from their IRA.
Even if they're not, okay?
Right.
And so that person who's already told me that they thought about self-insuring.
Right.
They have resources to help offset the inflationary aspect of this. What we're trying to do is we're not trying to say, okay, at the end, you've protected every penny of not only your base and your growth. What we're trying to do is to prevent a catastrophe.
Right.
And even if they had to spend a little bit more of their asset base to cover the inflationary side, we have a way to prevent the catastrophe from happening.
Yeah.
Which is the reason I'm sitting here.
Or even for wealthier families who could self-insure, you're still able to do it. You're protecting your family wealth. It's an insurance policy on the family wealth to make sure that it can go to the next generation too. So there's aspects of that.
And so what happens if a person's going to self-insure and the family wealth is there, and most of the time the children, the heirs, know about that wealth.
Right.
And so, like in our case, my wife and my wife's parents are both needing care, and my wife and I are the only ones. She has siblings, but they're all in other cities. And so, if that wealth is there, I'm going to try to take care of mom and not spend that money.
Yeah, to protect the wealth. Yeah, to a certain extent. There are situations where you care for people at home, but yeah, to a certain extent.
And so again, that goes back to what happens to the caregiver.
Right.
And most people don't think about that until the caregiver's already sick. So just having a level of coverage that is substantial enough to prevent a catastrophe, that's our philosophy.
Are you, when you're looking for a long-term care policy, how important is it on the grade of the company? So, kind of like when you shop, some people say when you shop for like a whole life policy, you should make sure you're using AAA or AA rated companies. And I disagree with that, by the way, at least with term insurance. It doesn't even matter. You just want the cheapest.
Yep. Well, I'm gonna answer that question by asking you a question. Because long-term care policies are underwritten under the life insurance umbrella of insurance regulations. They're not under health insurance. So how many people do you know in your life that have died and their life insurance policy did not pay the death benefit?
Yeah, zero.
You don't, that never happens. And the reason is because of the state guarantee associations. Even when a company goes under, the assets are liquidated and distributed to every state based on where the policyholders are. The state guarantee association still takes in premiums from the policyholders and pays the benefits. I have about 8 years ago, I got a check of about $14,000 in the mail that I wasn't expecting. And a friend of our family had passed away, and in the 70s, he bought a small life insurance policy, named me as the beneficiary. That company went under in 1982. Okay. And was dissolved and liquidated. And when he died, the state guarantee association paid the death benefit to me.
Oh, wow.
And so what we look for in long-term care, sure, you want to have a good rating. You want to have a company that's got credibility. Yeah. But the most important thing that we want to look for is a company that has a claims history that we wouldn't mind our mother having.
Yeah, right. How do you know that?
So, well, you can just do a lot of research, and we know we are being specialized in long-term care. I've got the personal cell phone numbers of a lot of the national vice presidents of most of these companies. And so we're able to get access to that kind of information and know. And so a B-rated company is not one that we have in our portfolio, but there are some B-rated companies that have good claims histories. And so, but everything that we have in our portfolio is either A or A plus or A plus plus rated. Yeah. Just because of the credibility aspect.
I have some experience with helping a client with CNA. I think they got out of long-term care a long time ago, but the claims process was very difficult. They found every reason possible to deny a claim. But they weren't in the business anymore. They weren't in the business of long-term care anyway.
Right.
So yeah, I've experienced that firsthand. That wasn't pleasant, but they did pay out. They did do that. just took a while.
Yep.
So, okay. Well, Randy, do you have any other updates for us?
I really don't. I will say that when we sit down with somebody, the main thing that we want to do is listen to what their need is. Because I will tell you that over the years, I have had multiple people that we've sat down with, and they throw in front of me here, well, here's what my auto agent quoted me. And every time it's exactly what you said. It's a $8,000 a month policy and the premium is unaffordable.
Right.
And, the word comes down to not really insurance, but it comes down to long-term care planning. And planning for a long-term care event is probably one of the last things that most people need to put in their portfolio that they've not done yet. In fact, I told one of your clients last week, I said, I give you one guarantee that if we go through this planning process, at the end of it, you're going to be satisfied. You'll either take action or you won't.
Right.
And you'll be satisfied that you won't ever have to think about this again because you addressed it. And addressing it is the key.
Well, if you want to listen to some other episodes with me and Randy, we have episode 146, The Power of Life Insurance to Meet Your Family's Goals. Episode 126 was How Insurance Can Protect Your Wealth. We also had a video that we did, a short video on our YouTube channel, which is called A Wiser Retirement, called Long-Term Care Insurance Explained. That's here in our show notes below. This is episode 179. Randy, we've been doing this a while.
Amen. I love it.
Anyway, thanks for listening to today's podcast. If you're interested in learning more about Wiser Wealth or Randy's company, you can schedule a consultation with us online. Randy, how do they find you? What's your email address?
Randy at ltcstep.com.
All right. Reach out to Randy.
Like Dave Ramsey's baby steps. This
Baby
is the
steps.
LTC, the long-term care step.com.
All right. We got that. Reach out to him there. Thank you so much for listening today. And Randy, thanks for joining me. We'll see you next time.
Thank you, Casey.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.